April 5th, 1933. There was no warning siren, no national argument, no public vote. People opened their eyes expecting a regular day, and before that day ended, keeping gold could label you a criminal. If you file that away as ancient history, you're missing the point. Because once gold was boxed in, the government leaned on silver too, not as a rumor, not as a theory, but in documents with timetables, penalties, and a fog of fear. So don't ask, will 1933 repeat exactly? It won't. Ask the real thing, are the ingredients being rebuilt for a modern look-alike, where hard assets get pushed out of private hands and drawn into the system without anyone ever calling it confiscation? Welcome back. Today is stripped down. Just the pattern, the gears behind it, and the uncomfortable truth most people refuse to say plainly. Do me a quick one. If you value clean, real-time breakdowns like this, tap subscribe and turn on notifications so you don't miss the next shift when it moves fast. Here's 1933 in plain English. The country was choking. Banks were failing. Work disappeared. People stopped believing paper promises. People didn't need a committee meeting. They felt it in grocery lines, in empty pay packets, in the look on a bank teller's face. In that climate, normal wasn't normal. It was denial. Uncertainty is powerful because it spreads by itself. It makes people police their choices long before any official shows up. And notice how friction works. The rules don't have to scream. They only have to slow you down, add forms, add checks, add waiting, until you ask if it's worth the trouble. So they did what felt rational. They tried to convert paper into something solid. They pulled cash out. They demanded metal. They hid gold away because gold looked like the emergency exit from a financial building that felt ready to collapse. That's when the government saw something dangerous. If citizens could run to gold, the government couldn't fully manage the money supply. And if it couldn't manage the money supply, it couldn't stimulate, it couldn't stabilize, it couldn't finance itself the way it wanted. So gold wasn't banned out of hatred. Gold was neutralized because it blocked control. Executive Order 6102 wasn't a moral speech. It was a lever. Turn in your gold, accept paper, and do it quickly. The threat powered the whole machine. Prison, severe fines, and the psychological weapon that does the most work in crackdowns. Uncertainty. Not everyone needs punishment. A small number of examples can make millions comply. Then came the part that still burns people who study it. After citizens swapped metal for paper at the official rate, the rules shifted. The official price moved. The paper's buying power got crippled. You didn't only lose the gold. You lost the upside you were trying to shield yourself with. That's the part people forget. Confiscation isn't only taking. It's forcing an exchange you didn't choose, then changing the math after you obey. Now look at silver. Really look. Gold wasn't the finale. Silver followed. In 1934, the government applied similar pressure around silver bullion, aimed far more at stockpiles, bars, and big concentrations than at day-to-day pocket change. Circulating coins had more breathing room. Bullion drew the spotlight. And the motive wasn't mysterious. The system wanted metal under centralized control. Not because it loved metal, but because it loved what metal stood for. Independence. A parallel store of value that doesn't require permission. If you hold silver today, notice another detail. The 1930s were not mainly door-to-door raids. They weren't squads kicking in every house. That's Hollywood. The real machine was the bottleneck, the financial choke points. Banks wouldn't help you. Institutions wouldn't process what you wanted on the terms you wanted. Power leaned on the pipes it already controlled. With silver, the strategy became even more efficient. The system didn't need every small holder. It needed the big holders. It doesn't have to chase a million minnows when it can net the whales with paperwork, deadlines, and pressure. Lock this in, because it connects the past to now. When a government wants an asset, it doesn't always seize it with force. Sometimes it makes owning it expensive. Sometimes it makes selling it painful. Sometimes it makes using it slow and annoying. Sometimes it buries the asset under layers of rules until the average person hands it over voluntarily, because the hassle starts outweighing the hope. That's the modern upgrade. And if you're waiting for a clean headline, confiscation order signed, you're already behind. The next version won't introduce itself that way. It will look like reporting. It will look like compliance. It will look like anti-crime policy. It will look like consumer safety. It will look like national security. It will look like tax fairness. It will look like everything except what it is. Why does any of this matter? Governments don't reach for these tactics when they're comfortable. They reach for them when they're cornered. In the 1930s, the corner was a monetary constraint. Gold limited printing, so gold had to be sidelined. Today, the corner is different: debt, interest, and control. When obligations swell into numbers regular people can't even picture, the system becomes allergic to exits, allergic to alternatives, allergic to anything that lets citizens opt out, and physical precious metals, privately held, are an opt-out button. Wealth without a login, wealth without approval, wealth that doesn't freeze because a database says so, wealth that doesn't care about a policy memo. I'm not here to promise agents will confiscate your silver in 2026. That's not the point. The point is colder. The system doesn't need to seize your silver to reach the same destination. It can blunt it. It can cage it. It can turn your insurance into a bureaucratic maze while smiling. Think about the toolbox now. In the 1930s, the state wanted metal for reserves, coinage, and monetary control. Today, it doesn't need your silver to back a currency. So why care? Because this fight isn't about backing. It's about behavior. A system buried in obligations wants predictable citizens. Predictable spending, predictable taxes, predictable capital flows. Physical assets outside the rails create unpredictable behavior. They create private sovereignty. And that is what systems under stress dislike. So the next pressure campaign is more likely to hit the on-ramps and off-ramps than the metal itself. Not a midnight knock, a daylight squeeze. And a daylight squeeze feels reasonable at first. It shows up as a new form, a new threshold, a new checkbox, a new delay. Nothing dramatic, nothing that makes the evening news. But each layer changes incentives. Each layer nudges behavior. It teaches people, quietly, that staying inside the system is easier than stepping outside it. And when enough people learn that lesson, the asset doesn't have to be taken. It gets functionally neutralized because fewer people can use it the way they intended. This is also why language matters. The same restriction can be sold as safety. The same barrier can be marketed as protection. The same squeeze can be framed as best practice. And the public often accepts it because the packaging sounds responsible, even if the effect is control. Remember, none of this requires villains in black coats. Systems run on procedures. Procedures run on checklists. Checklists run on fear of liability. Dealers comply because licenses matter. Banks comply because access matters. Businesses comply because they don't want audits, freezes, or reputational risk. And holders comply because life is busy and the path of least resistance is powerful. That's why a policy update can hit harder than a law enforcement knock. It reaches everyone at once, and by the time the public notices the pattern is already installed because it was built in small pieces that looked harmless when viewed alone. Step 1, visibility. More reporting, more forms. Lower thresholds, broader definitions. Wider, know your customer standards. Not because everyone is guilty, but because the system wants the map. Step 2, taxation as punishment. Metals often aren't treated like stocks. They're treated like collectibles in many frameworks, which can already mean higher rates on gains. If fiscal stress intensifies, do rates fall? No. They rise. A temporary surcharge becomes permanent. A windfall tax gets marketed as fairness, and your gains start feeling less like gains and more like a toll you never agreed to pay. Step 3, friction. Heavier dealer rules, tighter cash limits, more paperwork, more delays. Still legal to own, just irritating to move, and most people don't submit to tyranny. They submit to inconvenience. Step 4, the big one, digital dependence. Instant payments, always on rails, traceable settlement. And this is where people mix concepts, so keep it simple. A faster payment network is not automatically a digital currency. But it is the track a digital currency could run on. Once the rails exist, policy can pivot faster than the public can react. Now picture the nightmare and notice what it doesn't need. It doesn't need a confiscation order. Imagine a future where certain obligations, taxes, fines, licensing fees, big purchases must be settled through approved channels. Imagine cash limits shrinking. Imagine compliance checks multiplying. Imagine that selling a meaningful amount of silver triggers automatic flags, not because you did wrong, but because you became visible. You still own the metal, but the freedom you believed you bought begins to get negotiated away. That is modern wealth control, not a raid, a net. And the net doesn't have to catch everyone, it just has to catch enough people to change behavior. Now let's handle the pushback. Confiscation wouldn't work today. If you mean 1933 style, you're right, it's messy, it's politically explosive. Trust is lower, and enforcement is harder when ownership is spread across millions. So if you wait for the old playbook, you'll feel safe. That's the trap. The new playbook is built to avoid backlash while still achieving the goal, pulling more wealth into the taxable, trackable, controllable zone. Want proof that voluntary compliance is the weapon? Look at the past. Even in the 1930s, the government couldn't search every home. Huge compliance happened because people believed the penalties were too scary to gamble against. A handful of prosecutions, a few headlines, and fear did the rest. Now apply that to a world where money is digital, where spending leaves a trail, where transactions are easy to flag, where a bank can delay you without ever saying confiscation, where dealers can be regulated without you being singled out directly. In that world, you don't need a million agents. You need a few rule changes, a few enforcement stories, and a population trained to stay inside the lines. So why is silver special? Because silver isn't only a store of value. Silver is a working metal. It gets used up, it gets consumed, it gets scattered. Gold mostly sits. Silver gets burned into the economy. Solar, electronics, medical, power systems, industrial tech. That matters because governments can't treat silver exactly like gold without collateral damage. If silver gets restricted, industry screams. If silver gets too expensive, manufacturing margins scream. If supply tightens, strategic sectors feel it. Here's the paradox. Silver is harder to attack head-on, yet easier to squeeze indirectly because it lives in two worlds, money world and industry world. And anything that lives in two worlds is perfect for special rules. Not a ban, just a policy. Not a seizure, just a tax. Not confiscation, just compliance. Now add the market reality that makes this touchier. Silver isn't a giant market like government bonds. It's smaller, it can move fast, and it can turn chaotic when demand spikes. Industrial demand doesn't politely wait. Investment demand doesn't call ahead. Mining supply doesn't behave like a faucet. A large share of silver output is a byproduct of other metals. So even if price jumps, supply doesn't instantly flood in. It can take years to bring new production online, if projects survive permits, politics, costs, and time. So when silver tightens, it tightens like a vice. And that's when governments notice. Because in stress, systems try to prevent panic. And few things trigger panic like a metal moving violently while everything else feels unstable. Now the key psychological point. Many people assume governments only go after what they need. That's naive. Governments go after what they can capture, control, monetize, and use to steady their own situation. In the 1930s, it wasn't only metal, it was optionality. It was independence. It was the ability to hedge outside the system. That's what gets lost in the "is confiscation likely?" debate. The modern version doesn't require your bars, it requires your exits. So make it practical. If you hold silver, think in layers. Layer 1, legality. Today owning silver is legal. Full stop. Layer 2, liquidity. How easily can you convert it when you want, on terms you choose? Layer 3, optionality. Do you have more than one path to store it, move it, and use it? Because the people who get trapped are the ones with a single route. One bank, one dealer, one method, one jurisdiction, one approved channel. When rules tighten, they don't resist. They comply because alternatives don't exist for them. This is why the 1930s matter. Not because we're rewinding time, but because it proves a permanent truth about power. In declared emergencies, financial, social, geopolitical, property rights become flexible. An emergency expands as pressure expands. So what do? You don't panic. You don't daydream about agents at the door. You do the smarter move. You get ahead of the narrative. Stop asking, will they confiscate? Start asking, how do they quietly shrink the benefit of holding? That's the real game. And once you see it, you'll understand why the loud debates are often distractions. Bans create outrage. Systems prefer solutions that don't spark outrage. They prefer boring tools, paperwork, taxes, limits, permissions. That's why the next confiscation won't be called confiscation. It will be sold as a policy update. Here's the uncomfortable truth. Most people don't lose wealth in one blast. They lose it through slow surrender. Inflation grinds savings down. Taxes rise quietly. Rules change overnight. The liquid asset becomes complicated, and people lose the most when they wait for certainty, because certainty arrives after the opportunity window closes. That's why silver matters for so many. Not because it's magic, but because it's outside. It's tangible. It's real. And real things have survived paper storms before. But silver isn't a superhero. It's a tool. And tools work only when you understand the environment you're using them in, so sit with the cliffhanger. What if the future isn't confiscation? What if it's digital encirclement, where an economy becomes so dependent on monitored payment rails that anything outside those rails becomes second-class wealth? Not illegal, just inconvenient, not banned, just punished, not seized, just surrounded. That's the modern pattern, and it's already visible if you know what to watch. Before we close, do this now. Zoom out. Watch how fast rules change when fear rises. Watch how temporary measures become permanent. Watch how financial language can rebrand control as safety. Then ask yourself one question. If the rules change next month, do you have options or excuses? That difference is what separates prepared people from shocked people. If you want more of these breakdowns, sharp, simple, and built for real decisions, subscribe and turn on notifications. Don't miss the next one. And share this with one person who still thinks history can't rhyme again. If the squeeze comes as paperwork and taxes, not headlines, what would you do differently with your silver today? Let me know in the comments below.